As of right now, on this Tuesday, June 16th, 2026, at 7:30 a.m. Eastern Time, the live intraday trading environment shows Nvidia stock pushing up significantly during the pre-market session, trading at exactly $212.18 per share, which represents a strong upward swing of 3.41%, adding $6.99 from its previous close of $205.19. What is truly remarkable about this sudden surge is not just the immediate price bump on your favorite trading platform, but a massive fundamental catalyst that completely upends what the typical retail investor expects from this chip giant. Most people are focused entirely on graphics cards and artificial intelligence processors, assuming that hardware demand alone dictates the stock trajectory. However, the real trigger behind this morning's sharp upward movement is an astonishing debt market event that caught the broader market off guard, where Nvidia just pulled off a massively oversubscribed $25 billion corporate bond sale that drew in over $85 billion in raw investor orders, revealing a hidden, insatiable appetite among institutional heavyweights for mega-cap corporate debt that far exceeds the standard assumptions about tech equity volatility. This massive cash injection proves that big capital is treating the chipmaker less like a speculative tech play and more like a fortress-grade global institution with unlimited financial runway. When you look at how people talk about Nvidia stock or Apple stock on popular retail apps like the Robinhood app or through premium self-investing setups, the common consensus is almost always the same. Investors generally assume that the meteoric rise of artificial intelligence infrastructure is a known variable, and that the stock must eventually hit a hard ceiling due to eventual oversupply or a cooling data center market. The expectation is that the company is a high beta vehicle prone to massive structural corrections if big tech capital expenditures slow down even a fraction of a percent. The reality, however, is a fascinating contradiction because institutional managers are actively treating the stock as a defensive powerhouse, pouring funds into their treasury debt and locking up allocations within customized setups like Schwab Intelligent Portfolios or a standard individual brokerage account at major legacy firms. Instead of waiting for a cyclical downturn in hardware, institutional giants are treating this firm as the baseline infrastructure provider of the entire global economy, essentially transforming it into a high-yield utility company disguised as a hyper-growth silicon designer. This disconnect between the retail narrative of a volatile tech trade and the institutional reality of a stable long-term capital sink is driving immense daily swings and heavy trading volumes across the major exchanges. If you monitor the current institutional order flow on the Interactive Brokers platform, you will see a massive concentration of block trades that suggest deep-pocketed wealth managers are accumulating shares on any slight dip. Sector momentum across the semiconductor space has been highly erratic over the past few weeks, heavily influenced by broader macroeconomic pressures, including shifts in Federal Reserve policy as new chair Kevin Warsh leads his first major meetings, alongside geopolitical headlines that have caused wild fluctuations in commodity prices. Yet, while other tech mainstays experience sharp pullbacks, Nvidia stock is carving out a distinct path, supported heavily by systematic index buying and the rapid expansion of specialized investment vehicles like Fidelity ETFs and targeted tech sector products that force automatic purchasing of top-weighted megacaps. Comment below how many shares of Nvidia stock you currently hold in your portfolio right now, and let me know if you are buying more at these current levels or looking to diversify into other names. To understand why this morning's live price of $212.18 carries so much weight, we have to look closely at the sheer volume of capital moving through the markets. When everyday individuals engage in online investing, looking for reliable investment help on various investing sites, they often miss the massive institutional pipeline that anchors these giant valuations. Right now, daily trading volume is showcasing a highly aggressive tug-of-war between short-term macro traders using derivative platforms and long-term funds establishing permanent core holdings. The recent earnings reactions in the broader tech sector have shown that the market is punishing any company that merely meets expectations, demanding flawless execution instead. Nvidia has consistently broken through these high hurdles because its underlying financial metrics are fundamentally distinct from its historical peers, boasting a gross profit margin that sits comfortably above 60% and a return on equity that completely outclasses typical industrial benchmarks. This unique financial profile is exactly why the company is integrated so deeply across modern online investment strategies, appearing as a top holding whether someone is utilizing an automated robo-advisor or managing their own assets via SoFi Active Investing or a Fidelity trading platform. Retail enthusiasm on the Robinhood stock trading system remains incredibly high, with Robinhood fractional shares allowing a whole new generation of buyers to accumulate pieces of the chip giant without needing thousands of dollars upfront. At the exact same time, older, more conservative capital pools are accessing the stock through Fidelity mutual funds and and classic Fidelity Wealth Management Services, demonstrating an incredibly broad shareholder base that spans from teenage day traders to multi-billion-dollar retirement funds. These dual layers of support create an interesting dynamic where retail momentum provides a high price ceiling during bull runs, while institutional accumulation via corporate bond backstops and index replication provides an incredibly sturdy price floor during market sell-offs. When we strip away the daily market noise and look closely at what the company actually does, the core business model remains an absolute masterclass in economic moat construction. At its foundational level, the organization designs advanced graphics processing units and complex computing platforms that serve as the fundamental engine for high-performance computing, data centers, and advanced artificial intelligence models. They do not actually manufacture the physical chips themselves. Instead, they rely on a highly specialized fabless model, outsourcing the incredibly complex lithography and fabrication processes to specialized silicon foundries overseas, while focusing their entire energy on architecture, circuit design, and software integration. This software layer, specifically their proprietary architecture that allows developers to harness the immense parallel processing power of their hardware, is the true secret behind their dominant market position. It creates an ecosystem where once a software engineer writes code for their platform, migrating to a competitor becomes an incredibly expensive and logistically painful endeavor, creating massive customer lock-in that ensures recurring revenue streams long after the initial hardware purchase. This operational reality contrasts sharply with the older historical reports from a decade ago, when the business was viewed primarily as a cyclical hardware vendor entirely dependent on the health of the personal computer gaming market or the volatile swings of cryptocurrency mining trends. Back then, an investor looking for self-investing options on standard investing sites would view the stock as a speculative bet on high-end PC gaming setups. The transition from a gaming chip provider to a global data center powerhouse represents one of the most substantial corporate transformations in modern financial history. Today, data center revenue accounts for the vast majority of their financial print, rendering the traditional gaming business a small, stable side hustle by comparison. When individuals analyze these structural shifts through advanced tools like the interactive brokers trading software or inside their Fidelity IRAs, it becomes blindingly obvious that the company has successfully detached itself from the standard hardware cycles that historically plagued the semiconductor industry. Looking directly ahead into the future outlook, the tension between what the market expects and what reality will deliver is only going to intensify. The current market narrative assumes that as cloud service providers build out massive server facilities, their demand for advanced chips will eventually moderate, leading to a sharp drop-off in orders. This expectation of a looming cyclical cliff is what keeps many conservative wealth managers from going all in on the stock. However, the emerging reality suggests that we are entering a secondary phase of infrastructure development focused heavily on enterprise adoption, national telecommunications networks, and localized sovereign computing systems. Major global telecom entities are actively partnering to build advanced localized processing clouds, viewing these networks as essential national infrastructure. This means the addressable market is expanding far beyond a handful of Silicon Valley tech giants, pulling in massive capital from sovereign wealth funds, international governments, and traditional enterprises looking to integrate advanced automated flows directly into their physical supply chains. This expanding footprint creates a wide array of both distinct catalysts and structural risks that investors must balance within their portfolios, whether they choose to invest online via an automated SoFi robo-advisor or execute precise tactical trades using the advanced features of the Robinhood app. On the opportunity side, the upcoming launch of their next-generation chip architectures promises to drastically improve efficiency and processing power, likely triggering an accelerated upgrade cycle among existing data center clients who cannot afford to fall behind their competitors. Additionally, tactical acquisitions of enterprise software companies and predictive data analytics platforms show that the company is actively moving up the value chain, looking to monetize the software layer even more aggressively. However, the risks are equally concrete, including severe supply chain concentration risks, potential regulatory interventions regarding international trade restrictions, and the constant threat of capital expenditure fatigue among their largest corporate buyers. If a major tech giant decides to trim its infrastructure by even a small percentage, the psychological impact on the stock market could trigger intense short-term downside pressure, regardless of the company's long-term operational health. As you navigate these complex market dynamics, utilizing tools like the Interactive Brokers platform to dissect trading fees, or managing long-term savings through Fidelity brokerage accounts, the key to successful investing lies in separating short-term emotional narrative from long-term structural reality. Today's live intraday price movement up to $212.18, driven by an extraordinary institutional bond sale, serves as a powerful reminder that this company operates on a completely different scale than almost any other corporate entity on Earth. The market frequently expects a sharp structural slowdown, yet the reality on the ground continues to showcase an unprecedented level of institutional demand and structural cash flow generation that consistently defies traditional valuation models. Whether you choose to access this asset through specialized Fidelity mobile app systems, Robinhood cash management accounts, or advanced SoFi investing strategies, understanding this core tension between market skepticism and fundamental execution is what ultimately separates successful long-term investors from those who get wiped out by the daily noise of the trading floor. Keep a close eye on the volume trends, track the institutional block trades, and always weigh the prevailing market narrative against the hard, unyielding data of the corporate balance sheet.